When the markets go up, our portfolio will also rise. However, when it declines and then recovers, the same portfolio may not perform as expected. So this raises a very important question. Which shares should be adjusted? What is the right decision? Should the portfolio remain unchanged? If there's new money, where should it be invested? Are mutual funds a better option than individual stocks? Should derivatives like F&O be included? These are some common concerns in any market environment. There may be several such doubts, questions, or opinions in your head. Just reach out to us on Ask Me Anything, and you can ask us anything and we will help you. Reach out to us today.
So we'll continue this conversation with Shyam Sekhar in our next episode and understand a bit more on the Solitaire's philosophy and what is he thinking about it. The portfolio holds around 30 plus stocks. What is the idea behind this level of diversification?
It can even go sometimes to 35 or 40, not more than that. The thing is, we keep investing in businesses that we like, and our investors keep adding money consistently. They even do an SIP in a PMS, which is again a unique feature of how we encourage them to invest consistently. And we keep buying newer positions, which we have conviction in. Now, there could be an older position which I am having from 5 years back, which I have not sold. I may be holding it from inception. And I feel that it will give me market returns. I don't want to sell it just for the sake of buying another company. I'll sell a company when holding it makes no economic sense in terms of potential to create returns for the next 3 to 5 years. Suppose a company will start giving returns only after 5 years. Then, and it has already moved up, then I look at, can I, put these reserves to better use. But I don't otherwise just sell for the sake of selling something. So on the one side, there is a track in which you are buying businesses. On the other side, there is a separate track which they are selling businesses. We don't confuse these two tracks. These are separate tracks. When the market keeps coming down and I find more and more value, I keep adding businesses to the portfolio. When the market keeps going up and I find that companies are completely out of whack in valuation and they are discounting the distant future, at that time the number of scrips will keep coming down. So there is no hard and fast rule that you must have only 20 stocks or 30 stocks or 40 stocks. Somewhere in the spectrum we will be. The market decides on how many I will own. If the market takes the valuation of some companies way beyond what I am comfortable, if I have to own them, I will liquidate. If the market gives me businesses at valuations which are very attractive and I love to own them, I will add them to my portfolio without worrying about portfolio count of companies. Because I know it will again correct itself by itself.
Now, Solitaire has been consistently outperforming the benchmark. What do you think has been the key driver behind this? And also, what is this obsession of industry trying to beat the benchmark returns?
See, as far as Solitaire is concerned, even before it got branded as Solitaire, I had run that strategy for 10 full years.
Correct.
And I saw some really tough times, very, very painful bear markets. And I could clearly sense the resilience in that approach. So I was not in any doubt that it will perform decently. But as luck would have it, we started in August 2019. And we finished deploying in mid-February of 2020.
Correct.
And COVID hit in early March. So we were put through a very, very intense stress test in the portfolio. Initially, it didn't look like you were beating the benchmark. It looked like you were lagging the benchmark, maybe 1 or 2%. It's not as if you're lagging by 10%. So people immediately concluded that, oh, this won't beat the benchmark. Why should you give these people money? I can put it elsewhere. All sorts of criticism. Basically, when you become a manager and put a product in the public domain, the urgency to judge is very, very high. People want to conclude before they give you enough time to prove yourself. And an investment strategy like this, once it starts, takes 3-4 years to stabilize and then, pull away from whatever you want to treat as a benchmark. And once it starts pulling away, if the investment managers continue to run it responsibly, it will always be reasonably well in terms of, it will be doing well in terms of both performance and resilience.
Okay.
So we knew that, and we had the experience doing that earlier. So except for the brief period of COVID, the product has done reasonably well, and we look very closely to see where weakness is developing in a portfolio, where you need to act decisively, and where you need to let decisions run and not disturb a good thing.
Correct.
So all these are judicious decisions that we make along the way continuously, and we make them only when they need to be taken. We don't make them for the sake of taking them. As a result, I think that we are able to deliver a certain experience which is relatively stable. There is outperformance over the benchmark, but again and again, that outperformance is basically created over a few years, and then it sustains over long years. That is how we fashion this whole product experience. Because I don't go and gamble the money overnight. I don't deploy the money next morning.
Correct.
I don't take very high risk just to show returns. So many professional managers can be tempted to buy an illiquid stock and make a lot of money when others buy it. You can storify a company and then make a lot of money. All these things are not sustainable. They are not replicable. They are not sustainable. So I avoid all these things. Short of that, whatever return we can generate by focusing on the fundamentals, focusing on the valuation, and building our conviction, those things we do all the time, and those things actually contribute a lot to this outperformance. I think outperformance is no accident. It's a lot of hard work. And the second thing is, when you have a market like now, when we are actually seeing a strong drawdown, what we do is we encourage the client to invest a little more at regular intervals, maybe once a month, maybe once in 2 months. Maybe do an SIP and then a lump sum. So the investor keeps on investing when the market sentiment is weak. So he puts in more capital when the market sentiment is weak. And then when the sentiment reverses and goes back to even, let's say, a neutral state, the investor has actually made money. And anything which takes the business higher will lead to substantial outperformance. So this outperformance has a certain way of happening. And we are constantly aware that that way has to be adhered to. You don't do crazy things just to show performance. Right. While on the subject of industry obsession with outperformance, I think people are looking at linearity. Now, suppose I am buying a set of themes, which I believe will do well over 5 years. But there could be some policy disturbance like you are having today with respect to Trump's tariffs, uncertainty. For 2-3 quarters, you will see a lot of volatility. But look at it after 2-3 years, no? You would wonder, why did people fuss so much about that event and what happened in that company? Now, whether you are fussing about events in a company or you are fussing about events in a portfolio, which is nothing but a collective of companies, you are not being rational, because you think that performance at the portfolio level is slightly lower or it's below expectation or whatever. So there should be something wrong in the portfolio. But market can also value certain businesses wrongly, right? Small companies can easily get wrongly valued. When the valuation is carried wrongly, you will see it as a drawdown. It's as simple as it. No, but 1 or 2 quarters later, when the results start showing the company, the same company will start showing higher performance than the portfolio. But in the bad times, you would have gone hammer and tongs against that investment, thinking, why is my manager holding this? Why can't he buy better companies and stuff like that? So I think that patience is key. If we don't have conviction in a stock, I think it's fairly certain we would have got out. The fact that we are still owning a company means we still have conviction. We don't own companies just for the sake of owning. If you've gone wrong, we'll be more than happy to sell out and book the loss. Luckily, those instances have been fewer in our experience with the PMS. So, the key thing is to not compare, not benchmark with other products or indices. You compare with what is your long-term return. Let's say what's a 3-year, 5-year return you want, or 10-year return. And give it 5 years. In 5 years, if it doesn't make money, then you have every right to question. But you need to give it time.
Now, coming to portfolio construction, what are some of the key traits you look for in a company to add them to your portfolio universe?
The first thing is I would like to invest in companies with reasonable visibility of the business. I want to invest in a company where the business will do well over, let's say, 3 to 5 years. And I can be sure that if I, let's say, invested in the company and forgot about it and woke up after 5 years, it should have done well. And there are companies which if you invest and leave for 10, 20 years also, they still do well and you don't have to do anything. So look for such businesses. Because even if you have a few quarters or 1 or 2 years in between which don't do well, they wouldn't matter in a longer period of time. And there are some companies which always give you performance backloaded. Investment performance will be backloaded. But I look for businesses which can, sustainably grow. They won't be disrupted. They have a very good competitive position in the industry. They are very important to their customers. The customers won't leave them if there's another player. And once I see all these traits, I look for valuation. And if I like the valuation, then I buy. And India is such an oasis of such opportunities that you can choose from a very wide catchment of teams and industries and companies. So the opportunities are huge. But you must select where the valuation is correct and where you can make money by investing in it. For example, let's say you like a retail company and you paid a very fancy price, let's say 4 or 5 years ago. And today it's at the same price. Then it means that you have bet on the right company, but not at the right valuation. So I think that it's very critical to be tight-fisted in what valuation you pay for a company. And that's something I'm very, very particular about. And I focus a lot on that. I don't throw money at a company.
Understood. Now, talking about conviction, right? Portfolio on many stocks go through ups and downs. What brings that confidence to stay invested in these businesses?
Firstly, you look at 5 years history of performance. Let's say a company has 5 years history. When you look at 5 year history, you will understand what happened in the last crisis in this company. Because cyclically crisis keeps coming.
Exactly.
And then you understand how they overcame that crisis. So you understand what is their competence. And when you know all this, you can also anticipate how they will react to the next crisis, what kind of an issue can become a crisis, and whether the company has the capacity to preempt such a crisis or it's like a natural calamity, something which you cannot, do away with. You have to just live it through. So all these judgments have to be made before you think of deploying any capital in a company. So I think I like doing that, and that gives me a lot of confidence even before I put money.
Now, coming to exits, when do you completely exit a stock? What are the signs you watch for?
We compute what would be the return we would get at the current market price in every stock that we invest in. Let's say you're buying ITC. I'm just giving for an example. We would compute what would be the return you'll make if you buy ITC at 400. What would it be if you bought at 475? So like this, we do for every company. And then we get it validated by some other analyst or somebody else.
Correct.
And once we know what is the right valuation, in our mind, we set ourselves on that. And when it comes, we start buying it. Then we achieve scale. So it's a process. It's not a knee-jerk thing. Similarly, selling. Let's say I've set a certain valuation as fair. Company goes above that. Sometimes it goes 20%, 30%. We don't rush. Let's say it's one standard deviation above in valuation. Right. And you calculate that what return you will get is negative. At that stage, we'll sell. And if you see that industry's best years of growth is behind, it may normalize growth. Again, at this stage, we will sell. So we have to do the math of the future and connect it to the valuation and ask ourselves the question, is this company really having a very bright future? If you feel otherwise, then you go to a company which has that future. So at that time, you sell and exit this and go to that. You don't sell and exit a stock simply because you want to buy another stock. We never do it.
Okay. Also, any reason about corporate governance you'd like to talk about? Because in the past, we have taken some decisions.
No, always when in a PMS we are faced with a situation where the corporate governance looks dicey, oily, we get out. We don't wait.
Even if the valuations are in your
Not
favor.
too long, not too long.
Now, in our portfolio construction strategy we follow, we try to trim and exit positions, right? So, when valuations get stretched, so what framework are we following there?
Yeah, the return expectation keeps on going down. When it falls below 7 or 8, then we start thinking of selling. And when it goes to negative, we would have sold out. So we have a certain return expectation which we set for ourselves in the product. When it goes 20-30% below that, that's when we start selling. So that I leave a margin of error. What if my assessment of return expectation now? Many people sold this NVIDIA because they thought the returns are already in the price. But they kept on showing better returns.
Correct.
So I wouldn't like to look like a fool. So I will give a little more, cut a little more slack, but when it comes to that price, we'll kill it.
So Solitaire is known for low churn. How do you maintain that discipline, especially when the market noise is getting so loud?
See, we have a certain process how we ideate a new idea, how we validate it, how we come to the decision. Now this, I don't connect with the market mood or sentiment. I just keep doing what needs to be done. And when the market mood turns in our favor, we call ourselves to action. Whether it's on the buying side or the selling side, it's the same process. So we work independent of the market, but we always respect the market. We don't try to copy the market, but we don't invest in such a way that the market can copy us either.
Correct.
So you need to be very respectful of the market. And at the same time, you need to act in such a way that the market respects you. It's mutual. So we respect the market. We don't try to buy companies which cannot justify their positions in the market. We buy only companies which can justify what they tell the market. So, as you said, somebody who changes his projections, we don't bet on such companies. We buy companies which are predictable and which are guiding us very well.
Now, we have discussed some characteristics of the Solitaire portfolio, right? What makes you think Solitaire stands out from other flexi-cap products in offering? Like one big differentiator.
I think we take lesser risk and in the long term, we're making better returns. Whereas most flexi-cap products take higher risk to make the same returns or even less. So I think that the fact that we take lesser risk, run a process very diligently, deploy capital in a way which is very responsible, and then are willing to wait for returns, all these things come together very nicely. That is how we are able to deliver a stable long-term performance. We generally don't think 1 year, 6 months, 2 years. We look at 5 years. And generally from the third year itself, you start getting the results. So it is your responsibility to harvest those results after 3 years.
Correct.
So we basically condition people very well for this.
Okay. Now, to do this kind of risk-adjusted returns, you can't follow a model portfolio approach. So how are you customizing or creating tailor-made portfolios for your clients who are coming in now?
So we have a universe of stocks. We never invest outside that. We invest only within that universe of stocks. In that universe of stocks, we know every day what is the return you will get in each company. We keep periodically reviewing and setting what should be the allocation in each company. And we give a starting allocation, then how to build it. Then he does it and then we'll give another one. So we act very responsibly and very gradually. And that has helped and it has been wonderful.
What are you excited about over the next 3 to 5 years in terms of trends or opportunities?
I think anything which Gen Z demography needs is very exciting. I'll put it that way. Because these are the people who are going to yearn, going to learn, who's going to spend a lot, who's going to live a lifestyle which matches their income, and who don't have to worry at all. Whatever they look at, I think should be very interesting because they are going towards the newer things.
How do you think our Solitaire portfolio has evolved over the last 5.5 years?
No, the results are there for all to see. So I don't want to, comment about how we have done. And evolution is a function of how we want to grow. That is all. So we create bandwidth so that we are able to grow. And we invest in people because it takes time to create a person. Once you create a suitable person for a task, we don't let them go for a reasonable period of time. So we kind of work around this quite nicely and constantly, and that's working for us.
If there's one message that you would like to leave our clients with about investing in Solitaire, what would it be?
Don't worry too much about 1 year return now, but keep a close watch on the portfolio. See if, as managers, we're doing something differently. And ensure that in high-risk companies, you personally visit the company. Don't leave it to others. These are some of the principles that you need to adhere to. And if you adhere to that, then you're fine.
Thank you, sir, for your insights on how Solitaire has evolved and the philosophy behind building this portfolio. Thank you everyone for joining and listening patiently to our conversation on Talking Straight with Shyam Sekhar. If you would like to be part of this Solitaire's journey, please find the link in the description below. And please subscribe to get such more interesting videos from the iThought PMS.